Hey everyone, welcome to the Juniper Links accounting channel. My name's Caroline and today we're going to go over salary and dividends. So what are the differences between the two and why should they be separate? And essentially this is just going to expand on paying yourself as a limited company director, but also it's important to understand the differences between salary and dividends because they are two completely different things, which I will explain to you here in a bit. So without further delay, let's get started with the video. Okay, so first of all, what is salary? A salary is normally a set value. So for example, you would set like a yearly amount. You can even set hourly rates. If you had a full-time employment, then that would obviously be for the full 52 weeks of the year. And this amount is paid to you every month as equal installments and only really changes if you take time off. Basically, it's a fixed amount. So the salary amounts are also reported through something called RTI submissions, and these are real-time information. Payroll can be run anytime during the month, but the payment date on this payslip or the submission to HMRC should show the actual day that you get paid for your salary. So it's kind of like when you get paid is when you submit and report the fact that you've been paid as well. Again, the payroll submission itself doesn't have to be on the same day, but the payment date reported on the submission and the time you actually take the money from the company should be about the same. Salary is also taxed at source through PAYE, and that's pay as you earn. So this is like the employer's registration, and they get to report all of the information for their employees through PAYE. So if you're a company director running your own company, your company will be registered for PAYE in order to report your salary through the RTI submissions to HMRC. So it's also an allowable expense for corporation tax relief. Okay, so what are dividends? So these are paid to company shareholders, and this is not whether you're an employee or a director of a company. It only applies to shareholders. So if you're not a shareholder of a company, then you cannot receive dividends. Dividends can only be paid from available profits after tax, and they are not considered an expense for corporation tax relief because, in essence, dividends are a reward for investing in your company. And it's the same exact thing when you have like stocks and shares traders where you buy shares with a company. They'll pay out the profits to you from those shares in the form of dividends. You'll receive a dividend voucher for those. And then when you sell the shares, you would pay a capital gains tax on any gains that you make. These are usually paid out to you on a quarterly basis. But with your company, it is possible to receive monthly dividends. You just want to be careful and make sure that they're separated very clearly from your salary payments. And I will explain a little bit more why just a bit later in the video. So when I said it's considered a reward for investing in the company, your share that you've got in your company is when you first incorporate it, and it has to have a shareholder, and normally it's just a standard value of £1 as a share. So you will often have this £1 share when you open up your own company and you're the only shareholder in there. So this is why you can receive dividends from your company. It's not because you're a director, not because you're an employee, it's because you're a shareholder. And since you're the only shareholder in the company, you can receive all of the profits in the company. Dividends are not taxed at source, and they have to be reported on your self-assessment if you receive enough where they are going to be taxed for the year, because technically you received untaxed income. HMRC will catch on eventually and ask you to submit that self-assessment, so stay ahead of it. If you don't have an accountant to help you with this stuff, then you have to register for self-assessment if you are receiving dividends during the year. And this is because dividends do not have any tax deductions when you take them from your company, but they do have a tax depending on your other income. So they've got the same tax thresholds as salary, but they've got a different tax rate to salary. It's a bit lower, so I will get into that in a second. And it's a bit lower because you're already paying corporation tax on your profit figure before you can actually take the dividend. So you're already paying 19% on anything that you take out as a dividend, plus the dividend tax rate. why do I need to separate them? So why do you need to distinguish between salary and dividends when you're receiving them from the company? Dividends should not be confused with a salary because they're two completely different ways of paying yourself, and they've got two completely different tax systems. And it's important to make sure that you clearly separate them. So dividends are an investment reward with different tax rates. If you paid out your dividends complete with your salary, all in one transfer to yourself every single month, what HMRC would do is likely have a look at those payments and decide that all of that should have been salary reported through PAYE. And they will backdate this tax, and you won't be a very happy director at this point. So basically what you want to do is make sure you create separate transfers for each payment method. And this is good practice with everything. So if you're receiving expense reimbursements for yourself, separate them out from your salary. If you're receiving salary, don't pay them as part of your dividends next month. If you're receiving a dividend, don't just include it as part of your salary or part of your expenses. You want to make sure that everything is very clearly labeled in the company's bank transactions to kind of help HMRC not get confused by the fact that these payments are not all salary because they will try to find some way to tax you more. How to pay salary. So this one is pretty straightforward for the most part, and any accountant will be able to help you with this. If you've got an accountant, you don't normally need to worry about most of these steps, apart from maybe deciding what the best level of salary to pay yourself is. But again, your accountant will be able to work that out depending on your previous income during the year. So the first step would be to register for PAYE. So for example, as part of our service, we'll make sure the company is registered for PAYE and you don't really have to be involved in that process. And the next step is to decide on a tax efficient level of salary. And this is usually at the primary national insurance threshold for the year. So that one is going to be £9,500 is the primary threshold. And this can sometimes be different from the secondary threshold for national insurance, which is the employer's NI portion of your liability. But in that case, it's still worthwhile. I've had this question a few times. It's still worthwhile to run it up to the higher threshold because employer's NI is 13.8%, but your company gets 19% corporation tax relief on your salary still, and there's still no tax to pay because it's within your personal allowance. That's provided you haven't received any other income during the year, and this is just specifically for the 2020/21 tax year, and it could change in the future, so just check those rates. They're always available on the gov.uk website, but it normally comes up as one of the first search results if you use Google or something similar. And the third step is to make sure that the salary is actually reported to HMRC before you take it out from your company. And this one, again, the accountant would normally do this automatically for you. Usually they have a specific date that they run everyone's salary on, so you can just check with them if they haven't already told you when that is. And salary would normally be paid monthly through your company. For the liabilities, it's very common to set these up on a quarterly basis, and the tax year has set quarters. So if you've got national insurance to pay or tax deductions to pay on your salary, your company will take this off of your payments, so you just receive the net values. And when the payment date comes around, so quarterly basis means the first quarter is April, May, June, and the payment is due by the 22nd of July. And this repeats throughout the year. So then it's July, August, September, and then the payment is due by the 22nd of October for that period. Then it's October, November, December, it's due in January, and then finally the last quarter is January, February, March, which is paid in April. And it's always on the 22nd of the month. So if you do have a liability, this will be reported through the RTI submission. HMRC will expect the payment on a quarterly basis for the most part. It can be monthly though, so just double check that. It's all set up in the payroll software for those options. So the company basically stores this money that it needs to pay to HMRC based on the deductions from your salary. You don't have to do this personally, it's paid by your company. If the company has a national insurance liability as well for the employer's NI, this is not deducted from your salary. This is an employer's tax, and this amount again is transferred straight from your company to HMRC with those quarterly payments. So it kind of just transfers a lump sum because the whole amount gets updated through the RTI submission. And the final step is to transfer your salary after tax and national insurance from the business bank account to your personal account on the same day that the RTI submission has reported that you've received this money. That's the gist of paying salary. Most of this will be taken care of by an accountant, so the registration process, deciding your tax efficient salary, you just have to give them your previous employment income or any other income you've received during the year. Then the salary would be reported through the RTI submission, and you can set up that transfer to yourself for the net amount. So there's a lot more steps involved here because there are requirements to report salary, whereas, which we'll see in a second here, dividends are a bit different. So the first and most important thing, your company must have available profit after tax. And to work that out, we would basically take the calculation of the total turnover in the business minus all allowable expenses, and then deduct the corporation tax from that amount. So corporation tax is currently 19%. So you want to find the 19% value of the profit and then deduct it from that profit to work out what's available in the company for you to take as dividends. So a lot of software, for example, Free Agent, will automatically track this for you as the software is updated. So when you add in your invoices, when you add in your out-of-pocket expenses, and when you add in your bank transactions and explain them correctly, the main page of Free Agent will show you the available dividends in the company and make sure there's always enough money in the business bank account for taxes. So once you work that out, you can transfer any amount from that available profit figure to yourself as a dividend. And you would do that by just setting up a transfer from your business bank account to your personal account. And when taking a dividend, instead of something like a payslip, the directors and shareholders must keep a minutes book to record the meeting that declared the dividend. And this sounds very strange when you're a sole director and shareholder to have a meeting with yourself and decide how many dividends you want to take. So instead, a lot of software, again, like Free Agent, will automatically generate this minutes record and the dividend voucher to go along with the dividend when it's explained in the bank transactions. So you can always have a record of that if you use an online bookkeeping software that has this functionality. So that's a technicality that has to be kind of fulfilled. As a single director and shareholder, it doesn't really make sense, but at least you can cover yourself with those automatic dividend vouchers within a bookkeeping software. And you'll notice that there is no tax or tax deductions withheld from the dividend payments when you transfer the money to yourself. You're always receiving the gross value before tax. So what you want to do is set aside any tax amount in a personal savings account or just a personal bank account that you don't really touch in order to have that money left over when the tax is due. And let's go through the actual salary and dividend tax for the current year, which is 2020/21. So the income tax thresholds, when the tax rate changes, are the same exact threshold for both. So you've got the personal allowance, which has no tax and is up to £12,500. You've got the lower rate thresholds, which is between the 12,501 to 50,000. And you've got the higher rate up to 150,000 after that. And then the upper rate or additional rate at £150,000 or more. So obviously keep in mind that if you do receive over £100,000 of income, you start to lose your personal allowance, and I will get into how that impacts your overall liability soon. So each threshold has different tax rates for salary and dividends. And the only one that's the same is the personal allowance, which has no tax. So up to that 12.5k, there's no tax to pay, regardless if it's salary or dividends. The lower rate thresholds, between 12.5k and £50,000, has 20% tax on salary and 7.5% tax on dividends. The thing about salary is when you have those national insurance thresholds as well at either 12% or the 13.8% employer's national insurance, this all stacks with this 20% salary amount. So while it seems beneficial to take out a higher salary because of that corporation tax relief at 19%, obviously, looking at this 20% here makes sense over the dividends. But because of this national insurance extra amounts that you have to pay, it becomes less tax efficient than taking the dividends, which don't have corporation tax relief, but do have a 7.5% tax rate. The higher rate threshold between 50,000 and 150,000 has 40% tax on salary and 32.5% tax on dividend. The upper rate threshold after 150k is 45% on salary and 38.1% on dividends. So you're just at this point anyway, you're capped out on everything that you could be, so you would have no personal allowance, and also your tax rate would be at maximum. So if you're earning significantly above this, it's not going to really change that much. One thing that you do have with dividends, in addition to that personal allowance with no tax, is a dividend allowance of £2,000 this year, where there is no tax to pay regardless of your threshold. So for example, if you're earning a salary of £60,000 for the year elsewhere and you want to receive a dividend from your company, you can take £2,000 and there won't be any tax on that dividend because of the dividend allowance. Okay, so I mentioned national insurance earlier, just to touch up on that a little bit more. There are no national insurance deductions on dividends. Directors can use the annual NI thresholds for their salary. And what this means is that you're not capped out with the monthly thresholds. So if you're towards the end of the tax year and you've not received any income so far, but you still want to pay yourself a full salary of 9,500, let's say, you can just spread that out over the remaining few months of the year, regardless of how much that means on a monthly basis, and still receive the whole NI thresholds for that year. Just keep in mind that the national insurance thresholds do get apportioned based on your directorship start date. The primary threshold, like I mentioned before, starts from 9,500. This is employees NI. And after this initial 9,500, there is 12% deducted for national insurance. After 50,000, this reduces down to 2%. The secondary threshold is the employer's NI threshold, and this starts from £8,788. After this amount, it's 13.8% that your company has to pay. This is not deducted from your salary at all. This is just a company tax for running salary. So this does not change. It doesn't get reduced later. It's always going to be 13.8%. Just to recap, the employee's NI is deducted from your salary based on the primary threshold for the year. Employer's NI is paid by your company as an additional tax after the secondary threshold is reached for the year. So those are the two differences, and employer's NI is an allowable expense for corporation tax relief, so it is in fact a little bit less than this 13.8%. Let us finish up this video with key differences between salary and dividends. So salary is a guaranteed regular payment from your company. It doesn't often change that much unless you're taking sick pay or some kind of unpaid leave. Generally, it's always the same amount. And dividends are a reward for being a shareholder. Dividends can change. Dividends always do change. They're not guaranteed at all. So the only time we can actually correctly record dividends are once you've physically taken out the money from your company and then reported it on your self-assessment at the end of the year. These are the dividends you've received, and it doesn't necessarily mean you'll receive the same amount next year because anything could happen. Salary does have higher tax rates and it has national insurance deductions. After the initial personal allowance, it's not really worth running more salary, and same with NI deductions. After that initial threshold for employees NI, running more salary will mean less overall take-home pay. Dividends have less tax overall and no national insurance deductions, but they are paid from profit, and this is after tax. The other difference, salary is an allowable expense and can reduce corporation tax, which I mentioned a little bit earlier, and for dividends, you have to set aside the tax for the dividends. It's not automatically deducted when you take out the money like salary is. So salary will be reported to HMRC through the RTI submissions. Your company will hold the tax money for you and then pay it over to HMRC when it's due. With the dividends, your company simply just issues the dividends to you based on those meetings that I mentioned, the minutes, and then you, the taxpayer, personally are responsible to report that on your self-assessment and then pay the necessary taxes when they're due. So that's my video on salary versus dividends. Hopefully you guys have a good idea now of why a salary is something very different from dividends, and they shouldn't be mixed together in any way because it could cause confusion, and HMRC may want to tax you on the whole amount as a salary, which is obviously much less tax efficient than dividends. I hope this video was helpful. If I did miss anything out and if you've got questions, just leave them in the comments down below. Feel free to like the video if it was helpful or if you enjoyed it, and also do consider subscribing because I do often release videos like this. So if you're interested in that type of content, then do subscribe and hit that notification bell so you get notified when I upload a new video. Thanks so much for watching, guys. I hope you have an amazing day, and we'll see you in the next one.